Good morning and welcome to the LaFace webinar on our deferred compensation plan. I'm sorry, Jing Vida, the LaFace president, could not join us. So Lolita Mejia and I, Liz Lee, are the co-hosts of this program. So October is not only Filipino-American History Month, but it is also declared by the U.S. Senate as National Retirement Security Month. The city's deferred compensation plan is celebrating by inviting employees to play LA's The Place, a fun way to learn about retirement while testing your knowledge of iconic LA landmarks. Whether you are prepared for or still decades away from retirement, this month provides a great opportunity to focus on educating yourself financially. So, thanks to the LA Filipino American City Employees Association President and Board of Directors, thanks to Stephen Montagna, Personnel Department Employee Benefits Section, and Josh Geller, our active employee elected member of the Board of Deferred Compensation, for your help in making this webinar possible. So I'm Liz Lee. I serve as an advisor to the board of LaFace this year, and I really appreciate that you all take an hour and a half or an hour this Saturday morning to learn more about VOYA and our deferred compensation plan. So before we start the presentation, we would like to announce some housekeeping rules. One, please be aware all guests will be on mute except for the designated speakers to avoid any background noise. And we're trying to send a copy of the flyer, but if you don't, I don't think we can manage to do it right now. But it is attached to the email that we sent out. If you'd like to ask questions, please use the chat feature. I can either call on you or if you prefer, indicate on the chat if you would like me to pose your question for you. Questions will be entertained during key parts of the presentation. And if your name is not spelled out on the participant list, please rename yourself so we can identify you during Q&A. And please have your deferred compensation statement ready or download the VOYA app so you can have your e-statement. Lastly, please be reminded this webinar is being recorded and we will post it on our LaFace YouTube channel so you can tell your friends about it and they can watch it at any time they want. So a little background about the city's deferred compensation plan. Our DC plan is a voluntary 457B defined contribution plan that allows us to invest and set aside pre-tax or after-tax dollars from each paycheck to supplement our pensions during retirement. As of June 30th, 50,000 city employees are members of Deferred Comp with $7 billion invested. So our current DC administrator is VOYA Financial. I have the extreme pleasure of introducing our guest, Tanya Harris. Our speaker, Tanya, is VOYA's lead retirement plan specialist for the past 6 years. She has 17 years of financial services experience, and she conducts retirement education seminars and provides one-on-one counseling to active city employees and retirees. With that, I will now turn it over to Tanya Harris. Please give a warm welcome to Tanya.
Good morning. Thank you, Liz. Oh, thank you. How's everyone today? I am going to share my screen. And thank you for the opportunity to be here with you today. So I am going to go over, I have a presentation for you today to discuss, to give you an overview of deferred compensation and to provide you with some insight on how you can help you achieve your retirement goals. So I'll take it from the top. Deferred compensation is an easy way for you to participate in deferred comp. The money comes out of your paycheck on a biweekly basis. You decide the amount. You decide whether you want to do pre-tax or after-tax, but it is designed to supplement your city pension. When you leave city services, you'll receive about 65 to 70% of your income will come from your LACER's pension. However, the city realizes that you won't have enough to sustain yourself in retirement. You may not. So that's why they offered a deferred compensation program as a way for you to help supplement. So you control deferred comp, you own it. As I mentioned, and as Liz mentioned, you have the option to decide pre-tax or after-tax. Now, pre-tax allows you to defer your contributions on a biweekly basis before any taxes are applied to your paycheck. So the theory behind pre-tax is no tax today, tax at retirement. You decide how you want to handle your deferred comp during your working years. The other option is the after-tax Roth option. Now, this is not the same as a Roth IRA. I know some people, the term Roth triggers Roth IRA, but they are two distinctively different retirement accounts, and they have two different purposes. So within your deferred compensation, this is a 457 after-tax Roth. And I want to stress that because the rules, like I said, are different. So with the after-tax option, you could set aside money that has already been taxed, and then there's no taxes upon retirement on that money. But the IRS has a caveat. They always have a caveat. The IRS's rule states that you must be 59 and a half when you take Roth distributions. You have to be 59 and a half, and you must maintain the account for 5 years from the first time you make a deposit. So for example, if you start contributing to the after-tax Roth this year, and in 2025 you retire, you've satisfied the 5-year rule if you are 59 and a half. If you do not satisfy both of those caveats, you just pay taxes on the earnings. So the way it works is, for example, if you put in $10,000 Roth dollars and you earn $2,000 between now and the time you leave, say that 5 years, and you are not 59 and a half, you would pay taxes on the $2,000 only, and that is upon withdrawal. So the theory is pre-tax today, no tax tomorrow. No, I'm sorry, pre-tax, tax, no tax today, tax tomorrow. After tax Roth, tax today, no tax at retirement. So you have the option to select both. Some people will ask, what's the benefit of doing both, or how should I determine if I need to do both? The reality of it is how are you paying taxes? Because one way or the other, the taxman cometh. Either he forgives, but he doesn't forget. Either you have to pay him now or you have to pay him later, but you can decide that. So I saw one question in the chat that asks, how do I determine which one is best for me? Well, you have to ask yourself, when you are filing your taxes on an annual basis, do you have to pay the IRS every year additional monies, or do you get a refund? If you are getting a refund, if you are having to owe the IRS every year in April, you may consider before tax. And the reason being is because any amount that you put in lowers your taxable income. That is the benefit of before tax. So say, for example, you make $50,000 and you set aside $10,000 in deferred comp, that drops you down to the $40,000 tax bracket. So that is the benefit of before tax. Now, if you're getting a refund from the IRS every year, then you could benefit from after-tax Roth. So that means that you have some additional monies that you can put aside for that could be taxed, and then you wouldn't have the tax consequence later. You also have the options to do both. I tell people all the time, you can have some money that's pre-tax and you can have some money that's after-tax Roth. It's completely up to you. You can go between the two. You can change. You can start one or the other. It's completely flexible. It's completely for you to control. Now, when you get ready to retire and you take you want to take contributions from your deferred comp, you can take your before tax contributions with no age restriction, no requirements. There is no 59 and a half rule. There is no penalty for deferred comp. This is a government 457 plan, and it does not carry a 10% penalty for withdrawals. And the rules are completely different for government employees than what you may have be familiar with other types of retirement plans. So just keep that in mind when you're doing your planning. Okay, so I'm going to pause here for a moment because there may be some questions in the chat about this topic specifically. Liz, are there any questions regarding this?
I don't see a question about, pre-tax or after tax right now. There's one question about whether a DC member can withdraw anytime and at any moment after retirement. Is that correct?
Yeah, once you leave city service, and I'll talk about that later on in the.
Okay.
I'll answer it now, but I'll talk about it in detail. But when you retire, you can take your distributions anytime. There's no requirement for distributions other than you're off of payroll. That's the only requirement. So if there are no questions about after tax and before tax, I'm going to move on. Within your deferred comp, you have the option to decide if you want to do percentage of pay or a fixed dollar amount. Percentage of pay over time, you gain more, you could potentially gain more money in your deferred comp because as you get raises and increases, your money will grow. You're able to put aside more money. The fixed dollar amount is always, so far it's been preferred because it's easier to calculate. And when it comes down to the annual contribution limit, it's best to do a fixed dollar amount if you're trying to max out. It's really difficult to do a percentage of pay and max out. So just something to keep in mind. But the percentage of pay was introduced 3 years ago, and you have the option to set aside more money if you decide to go a percentage of pay versus a fixed dollar amount. The annual contribution limits, which are set by the IRS. The IRS is heavily involved in retirement accounts just in general. They pretty much set the rules that any plan sponsor, which is the city, provides. So they have to make sure that they follow those rules set forth by the IRS. And so every year you have the option to contribute a certain amount up to in your deferred comp up to these maximum limits, and they're based on your age. So if you are under the age of 50, you can actually put in $19,500 per year. That comes out to $760 per paycheck. So even though within the city you get 26 paychecks, the city takes that number and divides it by 25 so that you can get the exact amount into your deferred comp. What we tend to see people do is they will divide that number by 26 and it's incorrect, and then they don't meet the limit. So just make sure that you check with one of us at City Hall to determine if you want to max out, what that amount would be. The city does make an announcement annually about what that amount is. So if you're below 50 and you want to max out, the annual contribution limit is $19,500 divided by 25 is $760 per paycheck, starting from January to December. If you're over 50, the IRS allows you to put in $26,000, which comes out to $980 per paycheck. So you can put in a little bit more money when you're 50 and over. And if you are within 3 years of normal retirement eligibility, that means that by LACER standards, you can retire in 3 years, meaning that you're currently age 52 and you have 27 years of service, so that by the time you're done with catch-up, you are eligible to leave. You can enroll in the special catch-up. So the special catch-up biweekly amount is $1,560 per paycheck. So starting from January to December. Now with the special catch-up, you have to complete a form. You have to enroll in it, because what it does is it takes you from the $26,000 to the $39,000. If you are interested in catch-up, we encourage you to reach out to one of us representatives to help you complete the forms, because for accuracy, we need to help you complete the form to make it easier. Otherwise, if you try to complete it yourself, it may be incorrect, and then we have to walk you through the completion of it. So just something to keep in mind if you are interested in catch-up, okay?
Hi, Latanya. I just wanted to bring to your attention the city has two no deduction paycheck. I think, Lolita, could you correct
Right.
me if
I'm
I'm
aware of the no
wrong? Right?
deduction. The
Yeah.
city still
So
takes
there's
that.
20, yeah, 24. Is it 25 or 24 then?
There are 25, there are 26 paychecks. Two are no deduction, but deferred comp still comes out. Deferred comp comes out
Oh,
every
okay.
paycheck, regardless of
Thank
whether
you.
there's no deduction. The no deduction applies to your benefits. It does not
Okay.
apply to
Thank you
deferred comp.
for
Yeah,
clarifying that. Thank
sure, no problem. Any questions about limits or anything like that before I dive into investments? Okay, so I'm going to just move along. So I'm going to talk to you guys, spend a little time on the investment portions. I know when we scheduled this call and I spoke to Liz and Janelle, they had a lot of questions about investing and wanting to kind of help you guys understand how the investments work within the deferred comp. The first thing I want to say is your deferred compensation is an institutional account. It is ran and offered by the city of Los Angeles. It is separate than a brokerage account that you would go out and start with Charles Schwab or Fidelity or any other financial institution. It is completely within the confines of deferred comp, and it is a retirement account. So some of the things that you may experience in a brokerage account would not apply to this because it's a completely different type of account. So within your deferred compensation, the city offers, and I say the city because the city has offered these funds for the last 10 years. So the city does not really change the funds, and they are the decisioning body over the funds that are in the plan. It is not VOYA, it is not any other provider. So I just want to stress that many people believe that VOYA decides the investments. The investments are not decided by VOYA. VOYA is simply the record keeper of managing the records for your deferred compensation. So I just want to stress that. So within the deferred compensation that the board has decided, there are two core investment. There are, let's see, six. 1, 2, 3, 4, 5, 7 core investment funds that are available. The first two are savings, strictly savings, stability of principal. So the FDIC is just like your bank account. Okay, so that one pays about 0.5% per year, and this is per year. Then you have the stable value. The stable value is 2% per year. So those are the two savings options within the plan that you can select. So then the city offers individual stock funds, and the stock funds are actually mutual funds. And a mutual fund is a collection of the fund manager will group different companies together to create one low-cost way to invest. So for example, the bond fund is comprised of U.S. Treasuries, municipal bonds, and corporate bonds to create one low-cost way to invest. Because if you had to invest in them individually, they would be more expensive to you. So just keep that in mind. A mutual fund is just a conglomerate of different companies put together, packaged as one individual investment option. So in DCP, the city branded that as deferred comp plan for themselves. They branded these. So that just goes to reinforce what I stated earlier, that the city owns the plan and the city is the decisioning body for managing your deferred comp. So within the confines of the IRS rules, of course. So there is the next stock fund is the large cap. Large cap means that those are large capitalization companies. Those are your Fortune 500 companies. Those are what I call the granddaddy of the stocks. So that's where you'll find your Apple, your Google, your Facebook, your Amazon, Berkshire Hathaway, what else? Procter & Gamble. Those are your heavy hitters, but it's only the top 10 of the S&P 500. So what they do is the underlying company for this particular fund is Vanguard. So the Vanguard fund is used for the large cap. So that is your, these are companies that are $10 billion or more in assets. Okay, so they are all grouped together. The mutual funds are all grouped together based on asset size, with the exception of the bond and the international. So I'm going to move on to the mid cap. Those are companies that are $2 to $10 billion. So some of the companies that historically have been in the mid cap have been like United Airlines, Southwest Airlines, Motorola. So those historically have been in there, but of course, in light of COVID, those companies have been pulled out. So when the when the fund manager sees that the fund is underperforming or that a company is being impacted, they will pull it and replace it with something else. Now, you don't have control over the companies that are in the plan. That is all managed by the fund company that manages that particular fund. They make the decisions, and they actually have to appear before the board when there are issues with some of the funds, or if they want to, if the city has some concerns about the performance of some of the funds in the count. And the city also has an outside consultant through Mercer Investments that actually advises them and supports them in the decisions of selecting the funds for the plan. So it's not just the governing body on the Deferred Compensation Board. They actually have an outside consultant that actually helps them with those decisions. And they come before the board, just like VOYA comes before the board. I have to speak in front of the board every quarter to provide our activities. So just so you know, everyone is accountable here. And so we actually strive to make this a very successful plan for you and retirees. The next one is small cap. Now, small cap are companies that are 300 million to 2 billion. That's where you'll find companies like Domino's Pizza. These are everyday companies. Marriott Vacations was in there a while back. So these are just like everyday companies that we use. And so that is the asset size of the small cap. Then you have international. The international fund is comprised of companies like Nestle, Louis Vuitton, Hennessy Moet. Now they are in the process of trying to acquire Tiffany. So you have Bayer Inc., which is a pharmaceutical company. So you have different types of company within the individual fund. So this is your base. This is your excuse me. This is your core deferred compensation funds. This is your base. So I just want to stress that this is the base for creating anything in terms of your investments. Okay. Any questions about the individual funds before I move on to the profiles?
Latanya, I have someone, Divina has actually a question relating back to the after-tax Roth withdrawals. Is it okay to ask this question right now?
Sure, that's fine.
Okay.
I can take time for it.
Her question is it not that the deferred comp after-tax Roth withdrawals are not entirely tax-free since you still pay tax on the earnings or income?
So when we say tax-free, you pay taxes when you put the money in. But when you take it out, if you've met the two caveats by the IRS, 5 years and 59 and a half, then the earnings are tax-free.
Okay.
So when you take the money out, the entire thing is no taxation. We will not withhold any money for taxes. You have to let the IRS know. You're going to get a 1099 that you're taking Roth contributions, and you'll have to file it, but there's no tax on earnings. That's the beauty of the Roth. Okay. I hope that answered Davina's question.
I hope so. Well, if not, she'll follow up.
She'll let us know, right?
Yes. And Rose Tang has a question going back to the number of deductions. She's asking how many more deductions will be taken out for the remainder of the calendar year 2020. I have a copy of our
5. It'll be 5.
Okay. So 5 more.
Yes.
Thank you.
There's two in November, the 4th, the 18th, and then you have 3 in December, the 2nd, 16th, and 30th. They will take out for the 30th.
Okay, I think that's about it. And I have a couple questions that I told you about. Let me know when I could ask that question. Yeah,
Okay, so I'm going to go
we
on
can do
to
it
the
later, I
profiles.
think.
Well, I'll go on to the profiles, and then I thought I may have answered one of those questions because I did see some questions about brokerage and stuff like that. So I'm going to go on, and then at the end of the Schwab, then you can introduce those. Okay.
Sure,
So
thank you.
okay, so now I'm going to talk to you about, there's some additional investment options within the plan. These are what we call the risk-based portfolios. And so what the city has done has packaged the previous fund, the core funds, into these profiles based on your tolerance for risk. So for example, that ultra conservative one has 85% of it is comprised of bonds and the savings. So the bond and the stable value is in the ultra conservative. And then the other 15% are made up of the individual core funds, the stock funds. So you have a different percentage ratio of each stock fund within the ultra conservative. Okay, so the ultra conservative is for someone that was considered risk averse. They don't want to take on too much risk with their retirement account. It can be for someone that wants to use this in retirement, but they still want a little bit in the market. So, and when I say market, I do mean the stock market. So ultra conservative is 85% of it are the bonds and savings. 50% is the bond portion. 15%, 35% of it is the savings portion, and then the other portion are the stock funds that were on the previous slide. Okay, and the reason why I put them in this order is because I wanted you to have some understanding of what the base is for creating these. So then moving on to the conservative, that same bond that's in the ultra conservative, you have 50% bond, 15% of it is the savings option, and then the remaining 35% is in the stock funds. So if you wanted a little bit more in the market, but you didn't want as much savings, you could select conservative. Now, the reason the city pre-packaged these is some people don't want to have to figure out the different percentages on the individual funds. They prefer to just go with one individual stock fund, which has all of the funds in one package. It's just another way of packaging it to make it easier for you. The next one is the moderate. Now, if you notice, the bond ratio in the moderate is now lessening. It is now 42% of the moderate is bond, and 58% of it are the stock funds. If you notice, the blue has gotten a little bit bigger and the red has gotten a little bit bigger. So that just means that you have more stock funds in that moderate. That one is what I call the middle of the road because it has a good percentage ratio of stocks and bonds to give you a balance. These are what you consider balanced portfolios. So when the stocks are not performing, the bonds are performing. And when the bonds are not performing, the stocks are performing. So you could select one of these your entire career if you choose to. It's not necessary to pick more than one of these, even though you can, because if you notice, you get the same investments in each one, you just get a different percentage ratio. And they all perform a little differently based on that. So the more stock you have in your portfolio, you have the potential for greater gains. The more bonds and savings is designed for preservation. So I always say stocks are designed for growth, bonds are designed for income, and then savings is designed for preservation. So when you're in your early years of working, you want to probably have more in the stock fund because you can deal with the market's ups and downs, and you want that growth over time. As you get closer to your retirement, and I would say, maybe 1 year within retirement, 1 to 2 years within retirement, you may want to scale back and put some either in a single stock fund. You may want to just put it in what is that, stable value. So what happens is as you get closer, you might not want as much exposure to the equities, which are the stocks. So you put a percentage of your money, maybe 80% of your money in the stable value, but then you keep a little bit in the market. And you can always switch it around while you're working or even in retirement. I caution you when you're working not to move the money around so much, because that's when you experience your hard losses, because the market is going up and down all the time. And if you make emotional decisions, you can miss out on growth opportunities. So I would say if you have 20 years before you retire and you're in the large cap, just stay the course, even in the market, even if the market goes down, because once you make that change, you've actually impacted you've experienced that hard loss trying to get out of the market because you think you're losing. If you just stay the course, it'll come back up and then you'll have greater gains. So I'm going to keep going and talk about the aggressive profile. So if you notice, the US stock, which is the blue one, is gotten bigger. So the aggressive just means that this one has 75% of it are the stock funds. If you notice, the bond, which is the orange, it's gotten smaller. And then the cash is even smaller than that. So now this one has more stock in it. And that's what makes it aggressive, is because the percentage ratio is now 75% stock, 25% of it is the bond. And then if we look at the ultra aggressive, you see that the US stock is pretty much 90%. The non-US, which is the international, you have 90% of it are in the stock funds and only 10% of it is bonds. So you get the same investments in each one, but it's not necessary to pick more than one. I tell people all the time when I do these presentations, picking more than one portfolio is like being a little pregnant. You're either moderate or conservative or aggressive. You can't pick, it's not necessary to pick more than one. So just pick one and go with it, okay? And you can always change it, okay? I'm gonna pause there because I know I have a lot of questions that may have come up. And then I'll talk about the Schwab. Any questions? Specifically
there's a
about
question. There's a question from Nanette Vaughn. And her question is, if you have an international stock, does it mean that the conservative goes automatically to aggressive?
I don't think I understand that question.
Okay.
I am not quite sure. Maybe we could unmute Nanette and see if she can clarify this question.
Can you guys hear me? Hello?
Yes, we do.
Okay.
Yes.
Yeah, the question is that since I have a conservative portfolio, and I asked someone if I can have a 1% to do an investment for international stock. Does the conservative stay as is, or since I added 1% of international stock, will my conservative portfolio go to aggressive?
No. So here's what happens. If you selected the conservative portfolio as your portfolio, it stays the same. Nothing changes until you move it. What happens is you've just added another stock fund. You just added 1% to your overall portfolio. But keep in mind, you already have international in the conservative already. So here's how it works. On the previous slide, and I'm going to go back. The individual core funds are designed for you if you want to create your own portfolio. Mm-hmm. Okay. If you want to create your own, and then you could decide what percentage of international, what percentage of bond, what percentage of mid cap and large cap that you want. This slide, these individual core funds are for you to create your own. The other slide, the pre-packaged portfolios, has everything from the previous slide in each one of them, just a different percentage ratio. So all you did was you created, it's like you're double dipping. You already have some international, so you just added a little bit more, but it's not enough to, I don't know what your goal was, but it may not be enough to achieve what you may have been trying to do. I don't know if you just wanted to put a little bit in the international. I don't understand.
No, it's funny is that since you explained it to me, no one explained that to me that that I have an international already. Because when I asked the person before, he did not really mention anything much about me having an international stock on my portfolio already. So I didn't know. So I thought I don't have one. So I put a 1% of it. But he never explained it to me that I already have one on my portfolio. If I knew I have one, then I won't touch my conservative or add another international if he explained it to me that I do have that one. But now that you explain it to me, thank you very much for letting me know.
You're very welcome. And what I can do is we have a flyer that actually shows the percentage ratios for each fund. And I'm going to send that to Liz so that she could share it with everyone. And then, of course, if you have questions, you can give me a call, because it will actually show you how the breakdown of each fund within each portfolio.
Okay.
And off the top of my head, I don't know how much percentage of international is in the conservative. I know that actually I can look at it and kind of look. Okay, so if you look at the conservative, circle, right, and you see how much red is there. See,
Yeah.
non-US stock is considered international. So you already have a percentage within there. I just couldn't tell you the exact amount. I'm sorry about that.
No problem. But thank you
But
for
I
letting me know.
Yeah. So anything that you see that's non-US stock, that's your percentage of international.
Okay.
The orange are the bonds and the blue are the US domestic stock. So I hope that helps to kind of clarify it a little bit.
No, you did help me a lot on that one. I didn't realize that. Like I just mentioned to you, that person never told me I already have that one on my portfolio. He just said, okay, sure, if that's what you want. But if he did explain it to me, then I will not add another 1%.
Yeah, I always explain this because it can be a little confusing. People don't understand that the previous slide is your base for creating these. And if you already have it in there, it may not be necessary to put additional, or maybe it might be best for you to customize one that you want for yourself.
Perfect. Thank you so much.
You're so welcome. That's the whole purpose of this meeting.
Yeah, just as FYI, if you're interested in that flyer that LaTanya will share with me, just send me an email, liz.lee@lacity.org. Thank you.
Got it, Liz. Thank you.
Thank you for asking
And
your
you can
questions.
also,
Please keep them coming. Thank you.
yes,
Okay.
and you can also, Liz, be sure to share at the end. There's a slide for contacting us collectively, but you can also share my email and my phone number. The number that you guys reach me at is my cell phone number, so don't hesitate to call me anytime. I'm available to answer those questions.
Will do. Thank you. Okay, so we'll go on
Okay,
mute
are there
while
any
we talk.
other questions? Are there any other questions about the portfolios or this stock?
I have another question here from Jing.
Sure.
She's our president, Jing Vida, LAFACE
Hi,
president.
Jean.
Yeah, she can. Jing, do you want to ask the question? Oh, Lolita
Hi,
can
good
unmute
morning.
you.
Good morning, everyone. Thank you, Liz, and thank you so much, LaTanya, for being here this morning.
Absolutely.
So I'm not sure, it's not related to the slide that you were just discussing, but I thought I'd throw it out there. At what age can we start using our 457? Because there's a minimum for the Social Security and other things, but what age are we supposed to be using this?
Whenever you retire from the city, Jing, it's not based on your age.
Oh, because somebody, a former LaFace member who retired, asked me that question, texted me, because she said that she found out that at age 70 that you can use this. So now I have to tell her that it's wrong. So it's not.
I think she's misunderstanding. When you leave city services, you can take your money regardless of your age. If you're 32 years old and you have $1 million in your deferred comp, you can take it all out. The deferred comp does not have an age restriction. However, when you get age 72, you are required to take the RMD, which is I'm going to talk about later when it comes to distributions.
So
So
you
that's
can
what she
actually
may be
use
getting
it.
it confused with.
Probably. So age 72. I see. So we can use it at any time. No penalty for the deferred
No
comp?
penalty. As I stated earlier, keep in mind, this plan is different than your traditional retirement accounts, and it does not have the 10% penalty. I'll talk about that a little bit more when I get to distribution.
Okay, great, great. Thank
All
you.
Grace Ramos has a question.
Sure.
Grace, would you like me to ask the question, or do you want to ask your question yourself?
Hi. Well, it's about, I noticed there's a section that says stable value or stability principle. What exactly is that?
Stable value is guaranteed investment contracts backed by insurance companies. So for example, your larger insurance companies package together a fund that allows you to get interest on that money. It's a fixed account and it pays 2% per year.
Okay.
It's different than the FDIC, which is backed by what is underlying is banks. That one is just like your local bank account, but it pays more.
Which pays more?
The stable value pays more, but your, you know how you can go to your bank and you can establish the savings account, but the interest rate that you get on it is 0.02%.
Yes.
If that, the FDIC within your deferred comp at least pays 0.5%. So it pays more than your local bank.
Gotcha. Okay.
Yeah. So it's like a core fixed income, but it's very safe and stable.
Yes.
And so
Yes.
the interest rate that you earn or the earnings are really low, considered in comparison to other funds.
Right.
Yeah.
So for example, last year, I'll give you a comparison. The stable value is based on interest rates and the FDIC. So for example, the large cap last year, did 19% by itself. Just that one large cap, because the market did really, really well last year. So the large cap, the rate of return overall ended up being 19%, but the stable value was 2%. So if you are, if you've been in the large cap or if you're in the stable value, that's the difference of what a fixed account does versus what a investment does in the market. Now, of course, we've had a lot of fluctuations in 2020, so I can't say that the large cap is going to do that 20%, that 19% again. It might end up being 10%, but when you are in your deferred comp or any type of investment, is for the long term. So that means that even though you may have a downturn this year or last year, that's just 1 year out of 30 years of working, or it's 2 years out of 30 years of working. So you can't base your decisions based on 1 year or one snapshot in time, because it's going to change. It's sort of like owning a home, right? When you buy a home, say for $500,000, and in 5 years, your equity is going to go up and down, but you're not going to sell your home when the equity drops, because number one, it's your home, and number two, you want the market to come up and you want to buy low and sell high. Same thing applies for investing. Same thing applies. It's designed for the long term. It is not designed to make emotional decisions when the market changes, because that's only one time period, but you're going to work for 20 years. You see what I'm saying?
Yeah.
So you don't want to, like, I'll give you an example. A lot of people after 2009, 2008, they took their money out because they saw their balances drop. And just keep in mind, and I'm an investor as well, and I'm not trying to negate any experiences that you may have had, but it's only on paper. And when I say that, you don't need the money right now, right? So when the market dropped in 2008 and people experienced losses, they put their money in stable value and they kept it there for however long, right? Well, the market rebounded. So they lost 10 years of growth from being in stable value. They only got 2% on their money when they could have gotten 9, 10, 15% on their money for that same time period. So that's what I mean by making emotional decisions and moving the money around, because you could potentially hurt yourself more than what you think you're preserving, if that helps. Okay.
Would
Okay,
someone want that?
Latanya.
Oh, I'm sorry. I had
Oh,
another question
Latanya,
to
I
add
have
to that.
Oh, okay. Go ahead, Grace. And we have one more question. And then before we go on to the next few slides, I
Sounds
know we
good.
have, time is of the
For
essence for
Q&A.
Latanya. So we can keep some of the questions after or during the presentation.
I can't remember, but the portfolios that were set out, do they all have a little bit of percentage of, for instance, this stable value, or they don't have that at all?
Only the ultra conservative and the conservative have the stable value. If you look at the slide that I have up, the light blue is your stable value.
Oh, the light blue.
Yeah, so the conservative, the ultra conservative has 35% stable value. The conservative has 15%.
Oh, that's under other, I guess?
Yes, that is the other.
Okay.
Yes,
Other.
that is the other.
All right. Is it for
Okay,
then
we'll open.
someone who is later in their career and they want to preserve any of the growth that they received in some of the stocks, that they would want to go into the stable value?
Yeah, you could take a portion. What I do, I can't give investment advice, but what I help people understand is it's not an all or nothing. So let's just say you have $500,000 and it's been in large cap and you're about to retire. I would say take 480,000 and put it in stable value. For example, you could do that and keep 20,000 in the market, but you're preserving that 480,000. But you're also benefiting from any growth that could potentially happen with the market. You have to be comfortable with leaving, if you want, you could be comfortable with leaving a little bit in the market, because that's going to be your growth. And you want to at least get 3% on your money from your deferred comp. So if you can have a little bit in the market and have some in stable value, you should be pretty good with maintaining that that 3%, because that's the rate of inflation. If you're because as you in retirement, and I'm speaking specifically in retirement, your LAFACE pension, you're going to be receiving that. If the cost of living goes up, you're going to have to pull more from your deferred comp to live. So you want that money to still be growing. Even though you're not contributing, you still want some growth on that money. So when I talk to and counsel people one-on-one, I just say, hey, you may want to consider putting some in the stable value, because you have a really large amount in, large cap, or you have 100% in ultra aggressive. And it's not an all or nothing. Some people feel like it's all or nothing. I got to take all of it out and put it in stable value. No, you don't have to do that. You want to have some balance, and you could still maintain that balance by saving and some growth. It's just a balance.
Okay, Latanya, we have one more question from Nanette, and we can move on to our VOYA e-statement. Thank you. Nanette, please ask your question. Thanks.
Okay, my question is that, let's say, for example, you already retired from the city of LA, but instead of letting the city do the direct deposit of your retirement, can you put that retirement go to your deferred, or no?
Are you referring to your LAFACE pension?
Yeah, yeah.
No.
Instead of the LAFACE direct deposit to my account, I want them to direct deposit it directly to deferred. No. Oh, okay. But yeah. Can I still put? But can I still put money? Oh, okay. But can I still put that money to my deferred even though I'm already retired from the city?
No. Okay, so let me explain to you how that works. The deferred compensation is based on you receiving a pension, meaning that you are contributing to, you're an active employee. In order to participate in deferred comp, you have to be an active employee. You have to be having contributions to one of the 3 pension systems. Either you work for DWP, you work for police or fire, or you work for citywide and you're getting a LACERS pension. You have to be active contributing to those. Once you retire and you no longer get a paycheck, you're no longer able to contribute to deferred comp. The only way money can get into your account is as a rollover. If, for example, you had an IRA, traditional only, that you can roll into your deferred compensation plan. You cannot make deposits to deferred comp.
I see.
So
Okay, thank you.
the only way money can go in is either your paycheck or with a rollover.
Got it. Thank you.
We got
Okay.
another question from
Tanya,
Jen.
there's a question from Davina here that says, in the event, let's say, someone passes away and they have designated beneficiaries.
Can we hold that? Can we hold
Okay,
that
we'll
question
hold
for
that.
later, because that's later in the presentation.
That's
Okay.
fine. Thank you.
Thank you. Okay, so the self-directed brokerage option, this is offered within your deferred comp as another investment option that you have. The Schwab has a $50 annual fee that's taken out quarterly from your account. It's $12.50 per quarter. The minimum transfer is $1,000 from your core deferred compensation account, and you must maintain $2,500 in your core account. I had someone ask me yesterday, I was taking calls, if they could put their whole deferred comp into Charles Schwab, and I said, no, you can't. You have to maintain $2,500, but you can put all of it except $2,500 in there. So within your self-directed brokerage account, the provider is Schwab. That is, once again, decided by the city, and it has been Schwab for many, many years now. But you get more opportunities to buy individual stock that's on the New York Stock Exchange, NASDAQ listed funds, ETFs, bonds, and registered mutual funds. So it just gives you more variety. Say, for example, you wanted to buy Coca-Cola or McDonald's. You can take some of your money over from your core deferred comp account and buy those companies that you like. It just gives you, it's just another option to buy, companies that you may, if you want to buy Netflix, you can buy Netflix. Which is not available within your core deferred comp offering. You can buy those on an individual basis if you choose to. Okay. And I'm just going to keep going in the essence of time, and then I'll answer any questions. So because you have a deferred compensation plan and you're a city employee, you get low cost fees. Actually, your deferred comp fees are 0.09%. Once you get a minimum of $125,000 in your account, your annual fees are $115 maximum. Okay, that is the administrative fee. That is the cost for managing the plan, period. Any investment fees, which are called expense ratios, are for the fund manager. For example, the large cap, the underlying fund for that is Vanguard. The expense ratio fee, the fund company is Vanguard. Their fee on that particular fund is 0.02%. So because this plan, the city's plan is $7 billion, you take advantage, they leverage that and they get low fees. So if you have a plan outside of the city, say, for example, it's at Morgan Stanley or Chase or wherever it is, your fees on that plan are going to be much higher than it would be for your deferred comp, because this is an institutional account, and you take, and the city can leverage the size of the plan to to have lower cost fees. There is on the deferred compensation board, there is an investment committee that always strives to offer the best investment options at the lowest cost for members. There are members that want to be more aggressive and want more options. And so the city considers that as well when they make those decisions. But you still have the flexibility to control your deferred comp any way you want, okay? So I just want to stress that.
Latanya, there's a question that's very relevant to this slide. You know, many brokerages now offer zero management fee funds. Is that something that VOYA can control, or is that the board of deferred comp making those decisions?
Okay,
I
so
think you,
the deferred compensation is an institutional account. So what you're referring to is a brokerage account that is separate than your deferred comp. Brokerage is retail business. This is institutional. So we don't even compete in that range. And so they are completely, it's like buying a Lexus versus Mercedes, two entirely different cars. They have two different purposes and things of that nature. So they're not one and the same. So a brokerage account is different than a deferred compensation account. I hope that clarifies that question, because I did see that. Yeah.
yes, thank you.
Okay. So retirement calculator. Within your deferred comp, you have this groovy retirement calculator. I love talking about this calculator. I'm going to spend just a little bit of time on it, just to kind of give you an overview of how this calculator works. So this calculator allows you to put in your pension, and it's actually a projection to help you see if you're on track to achieving your retirement goals. So this estimated monthly amount here, where it says $10,633, this is based on your deferred compensation balance. So what VOYA does with this calculator is, when they built this calculator, they said, okay, whatever balance you have in your account, we're going to annuitize that. And annuitize is, we're just going to take that amount and calculate a fixed number of payments, right? Just for your balance alone. Then your monthly goal is based on what's in the About Me section. So under this About Me, when you click on that, it's going to have your birthday, it's going to have your salary, and it's going to say that you want to replace 100% of your income for retirement. Now, the city's goal is for you to have 100% replacement income for retirement, right? So remember when I started off, I said you'll get about 65 to 70% will come from lasers. Where's the other 40% going to come from? 35 to 40%. Is it going to come from deferred comp? Is it going to come from outside assets? You may not be eligible for Social Security, and then the Social Security that you may receive may not be enough to cover that full 35 to 40%. So that's why, the city offers the deferred comp. So this About Me says that you can replace 100% of your income. You have the option to say, okay, I'm going to change it to 80%. How much would I need to, do 80%? So you have flexibility. So then that's how it creates this monthly goal, by you putting 100% under the About Me, okay? And it factors in your salaries. So it's saying, okay, if you're going to retire, you're going to say, I want to retire over here at age 60 or 65 or 55. It will factor that into these numbers, because it's going to know when it knows your birthday. Remember what I said, it knows your birthday, and then you're saying you want to retire. So it's going to calculate automatically behind the scenes whether you're going to, how much you're going to have. So then once this orange money is filled up, voila, you're on track. If you are not on track, your orange money may be here. It may say that your monthly income is here, your goal is this amount, but then you have a shortfall. So you're going to have another number here if you didn't have enough, right? Then what you would do is you would click on this and, when you click on that, under that, it gives you, click on retirement savings, it gives you the option to factor in your LACERS pension. It's going to ask you how many years of service you have by the end of the year. You're going to put in, 25 years. It's going to ask you for a cost of living. You just leave that, you just keep that information static. And then you hit enter, and you'll come back out, and then you'll see that your orange money is full based on when you're going to retire. Now this dial here, if you're going to work longer, these numbers are going to go up because that means you're going to be contributing more, and that means there's more that's going to come from your pension. So if you retire at 60, if you move it to 60, this number will change. Your goals will change. Okay. So just keep in mind, if you touch any of these when you're on the website, in terms of your contribution, it will change your contribution. So you want to be careful with that when you're actually in it, because you have the option to make the change now or save it. You definitely want to save your retirement age, but you can leave the percentage and your investment return the same unless you want to play with it. Okay, just something to keep in mind. But it allows you to factor in your pension to let you know if you're on track. And keep in mind, it is just a projection. It is not an exact. Okay. So now, if everyone could pull out their statements, I'm going to go over how to read your statement. How am I doing on time so far? So far, so good. Anybody watching my time?
Yeah, it is 11:07, and
Okay.
this is supposed to end at 11:30. So
Okay.
I think we should be able to cover this pretty extensively. And just a reminder, if we don't get to your questions, Latanya will be available. She'll provide us her email and phone number.
Can I just add something? We have it until 11:30, but the Zoom meeting itself has been extended. So if there are a few questions, and if Latanya or Liz is still available, we can actually go beyond. Only if if Liz and Latanya are okay. Otherwise, it's 11:30. Thanks.
Okay, thank you. I'm going to continue on. So you should have recently received your quarterly statement, or it should be in the mail for the third quarter. They were mailed on the 21st, and I think the 21st was Wednesday. So you may or may not have received them yet for the third quarter. So the first part of your statement, of course, it has your name, it has our contact information, LA457, and the website, and the phone number. On the left side of your form, it shows your total account value as of that day on 9/30. So that's your balance as of that day. So understand that your statement is for the 9/30 statement, it starts July 1st through September 30th. That is for that time period. So by the time you get your statement, this activity is already old, okay? Because it's a snapshot. Just look at it as a snapshot for that time period, and it's on a quarterly basis. So the statement will show your opening balance. It'll show your employee contributions. If you had an outstanding loan, it would show other credits and payments here. Your investment gains or loss. This particular participant had an $11,759 gain. Your distribution and debits are your fees. So the fees on this is $28.75. And then it's going to show you any changes that you had during that period, which is your fluctuation. So it shows your contributions, and the gains are total $18,730. It's going to show you the performance for that time period. So where it says current period personalized investment performance, that is your personalized investment performance from July 1st through September 30th only. Okay. Then the next line shows you your performance from January to September 30th. So you see the vast difference there. A longer time period, you get different returns, because the longer the period, depending on how the market is fluctuating, will give you a different rate of return. Okay. The shorter time period, the number is usually either higher or lower, depending on what happened in that time period. For example, if you look at your statement from March, to July, from June, probably not so good. These numbers may have been negative even. And that's okay, because it was just for that time period, but because the market rebounded. So this is what I'm talking about when you get your statements, making emotional decisions. So then on the right side, you have your account balance history. Now, keep in mind your deferred comp history only goes back to 2017 because that's when VOYA took over the city's plan. So yours is going to start with 17. Your account balances, that was in the fourth quarter. So this is how you can see how your account is growing year over year, okay? So then I'm going to go to page 2. So page 2 is how the breakdown of your money. For example, your asset allocation, it shows you if you have asset allocation, by the way, is the profile funds. That's another term for the risk profiles because it is already, it's a one investment in itself. So it's considered asset allocation. Just so you know that term, it gives you built-in diversification within that one investment option. Okay. Then you see the stability of principal, the bonds, and then the individual funds. And it tells you, if you notice, the measure is not shares, it's units. Because these are mutual funds, when you're in mutual funds, you buy units and not shares. Shares are with individual stocks. Okay. Then it shows you the amount of shares that you have, the price that you paid, and the market value. That is for that time period. Now, keep in mind, once again, it's going to change based on how the market performs. The next section are important messages about retirement and diversification. And if you notice, it starts off talking about long-term, on this sample, long-term retirement security. So you want to, once again, I stress that this is a long-term investment and you don't want to make emotional decisions about your investments, okay? I'm going to go back up for this particular one. It shows that this person has 96% equity and 4% world equity. So that means that they are 100% in stocks. 100%. They have no bonds. They have no stability of principal. They created their own investment option the way they wanted to, and they have so much in large cap, so much in mid cap, so much in small cap, and so much in international. So they customize their own investment portfolio using the investment options, the individual funds. This is an example of that. If you have asset allocation and you have individual funds, the same individual funds here are also in the asset allocation. Remember I said the risk-based profiles has all of these funds in them. So you might be duplicating your efforts there, okay? Then I'm going to scroll down to the bottom, your pre-tax, where it says your current payroll. Those are your contributions. So this particular participant, it looks like it was $700 on my copy. You guys may have more. And then it gives you the breakdown of what you have in your contributions. This person has 50% large cap, which goes back to what is at the top. 25% is mid cap, and 25% is small cap. So I want to say something here because in this particular case, 100% of this person's portfolio is in stock funds, but they have a balance in the international. So you can be contributing your money on a biweekly basis to large cap, mid cap, and small cap, and you can maintain a balance in the equity. In the international or any other fund. So you can, your biweekly contributions could be one thing, and then you could have a balance in something else. But just keep in mind, it might be duplicating. So keep aware of that. So if you have, like I said, an asset allocation, and then you have money that's in the small cap or the mid cap, those same small and mid cap are in that asset allocation. So you just want to be cognizant of that. Even if one thing I do want to point out in the investment elections and future contribution section, you might be contributing before tax, but it's going to show Roth because that's just the way VOYA populates the statement. I'm sorry, lost my train of thought. That's just how they populate that. if you could have, it's going to always put something there. Whatever you have in the pre-tax is going to do the Roth. Now, if you have an actual percentage in Roth, it's going to show that. But if you don't have anything in Roth, just know that it's going to populate both pre-tax and Roth, because that's the option that you can put in there. I don't know why they do that. I've asked them not to, but that's just their standard statement. So don't freak out if you see that and you know you don't have Roth, but it's showing that. That's just the structure of the statement. Now, the next section is your activity. In this particular case, it's going to show the balance, what this person had on July 1st. It's going to show the contributions, how they were put in. It's going to show if this person had any loan payments, the actual breakdown of the gains and losses for each fund that they had, any transfers that they did. Say, for example, they moved from large cap to international. It's going to show that. And it's going to show the fees. Now, the fees here, these are the fund company fees. So the large cap, and everything is based on your balance. So because the majority of the money is in large cap, I think this one had a $20 fee for that quarter. And then if you look at the international, it's $1.28, which totals $28.75. So in this particular case, the fees are very small in comparison, okay? Then it gives you the breakdown. There it is, administrative fee. This is the fee for administering the plan. Okay. Then the next section are your before tax contributions. And in this case, the person did actually have Roth, and it's showing you the year-to-date contributions and the market value. So it gives you a complete breakdown of how your money is structured. Okay. Then the next section shows you your beneficiary. I encourage you all to keep your beneficiaries up to date. You can designate someone, whoever you want as your beneficiary. It could be, it doesn't have to be the same person with lasers. You can designate your mother, brother, sister, cousin, me, but it will always appear on your statement, okay? And then at the end, the city always offers statement messages just to kind of keep you engaged. So for example, on a statement, I think the 30th statement may talk about the National Security Retirement Month. They may talk about that because we want to promote it. It might be other things that the city may be doing that they want to promote, like if the contributions increase for the year. And just to note, I don't think they'll go up for 2021 because of COVID. Usually, if our economy is not doing well, the limits will probably be the same for 2021. So there'll be a statement message there about that. They're just going to say the limits remained unchanged for 2021. These are the limits for 2021. So you'll see a statement message there, and that usually will come on your fourth quarter statement, which comes in January. Okay. And I'm just going to keep going in the essence of time, and then we can ask questions in the end. Now, some of the other features that are available within your deferred comp, you have the option to set up automatic contribution, set up your contributions automatically. And when I say that, you can have it set to increase on your birthday. And so that helps you maintain your, you don't have to think about it because it's set up automatically. So that's a great tool to have if you know you want to increase your contributions on an annual basis, but you don't want to have to remember. You could just set it up for quarterly increases or annual increases. I talked about the management investment fees. You do have the option to initiate a loan on your deferred comp. You can do that while you're active or retired. There is a $50 loan origination fee and a $25 annual maintenance fee for maintaining that loan. The loans you can do are either a principal resident loan or a general purpose loan. You have the option to borrow up to 50% of your balance or $50,000, whichever is less, within a rolling 12-month period. So if you want to borrow $50,000, the payments are deducted from your paycheck. If you are retired, you have to, the money is deducted from your checking or savings account on a monthly basis. But when you're working, it's a biweekly basis. The interest rate is always 2% plus the prime lending rate. Right now is 5.25%, but you get the interest back. It's the only place I know where you actually get the interest back on any money that you borrow. Okay, the interest goes back to your account. So if you borrow $50,000, I think the payment is like $900 and some odd dollars, or $4 something per paycheck. The interest, that whole payment goes back to your deferred compensation account. With withdrawals, when you get ready to retire, you can set it up to have your withdrawals come to you. You can do it online. There are 3 options for initiating a withdrawal upon retirement. You can do it online with a paper form, or you could do it over the phone with a live representative. As long as you have your authentication PIN, you can initiate the withdrawal over the phone. You also have the option to set up direct deposit. If you initiated a loan and you want the money to go directly to your bank account, you can have that money go directly to your bank account. The only requirement is your banking information. There's a 7-day waiting period for your banking information. When you retire, you can have your direct deposits go directly to your bank account. So make sure that you put your banking information on file. You also have the option to pay off a loan online. You can put your banking information on file and pay off a loan. If you want to make additional payments on your loans, you can do that by mailing in a form along with the check. You can't make additional payments online, but you can, pay it off online. And there's no prepayment penalty for paying off loans. You could do it anytime. Okay. The next thing, rollovers. If you have other retirement accounts that you want to roll into your deferred comp, you can do that as long as it's in the format of a retirement account, such as a 401k, which is private sector, 403b, which is nonprofit, or schools. If you have a thrift savings plan that you work for the federal government, if you have a traditional IRA, you can roll those types of accounts into deferred comp. The only thing the plan does not accept is a Roth IRA. Roth IRAs are not allowed because there's no Roth IRA there's no Roth in the plan. Purchase a service credit. You would do that through LACERS. You could take, if you worked, part-time for the city at one point and you want to purchase some service credits, you can do that using your deferred comp account. You start with LACERS and you end it with us. There's a form that you would provide to LACERS, and then they give you a trustee-to-trustee form. You bring that to us. And then there's a purchase of service credit form that you complete, and then we send it over to the city for approval, and then send it to VOYA. VOYA cuts a check, sends it over to LACERS. Your purchase is done. It's a very simple process. Installment payments. When you retire, you have the option and the flexibility to manage your account however you want. When you leave city services, you don't have to touch your money at all. You don't have to move it. You don't have to take it out. You can leave it wherever it is. It stays in the same investments that you left it in until you change it. We won't do anything with it. And then you can set up installments, or you can do lump sum payments. You totally control your deferred comp. If you don't want to take any money that year, don't. But then at 72, you have to take what is called the required minimum distribution. I always say at age 72, the tax man come knocking and he wants a portion of your money. He says, happy birthday, you're now 72, I want the gift. And guess what he wants? He wants the gift of taxes. So you haven't paid taxes all these years, so now he says, happy birthday, I want the gift.
LaTanya, there's a question here that's very relevant to what you're saying. So you pay tax on the contributed portion. Do you pay tax on the earnings portion? What you earned? Okay,
so are these pre-tax?
The pre-tax
contribution? Yeah, anytime you keep in mind when it was pre-tax, you didn't pay taxes on it. You got the benefit, you got the tax benefit. Remember I said you got the tax benefit every year when you filed your taxes. You were able to lower your taxable income. So you got the benefit then. So you deferred your taxes. So any taxes, any money, the principal and the interest is taxed at that time. Whenever you take a distribution pre-tax, It's all lumped together, and you say, I want $5,000, we're going to send you like $5,000.
As you
And
said,
we're going
the
to withhold.
IRS, Uncle Sam's going to get their share, right?
That's right. Taxman cometh. He forgives, but he doesn't forget. The withholding for any distribution is 20% for the federal and 2% for the state. Now, that is the minimum withholding. You can request that they take out a little bit more so that you won't have to pay more in taxes in April. But keep in mind that your deferred any distribution is just like while you're working, right? You get your biweekly paycheck. The IRS has already had their hands in it. And then when you file your taxes, you get your W-2 at the end of the year, and you file your taxes. If you pay too much, you get a refund. If you didn't pay enough, you owe the taxman. Same thing applies when you're in retirement. Some people ask me, do I still have to pay taxes when I reach a certain age? Yes, you have to pay taxes until after you die, because that's just how he works. You have to, when you're in retirement, you're going to get a 1099. Once again, if you didn't pay enough, you got to pay him in April. If you pay too much, he'll give you some of it back. Same thing applies.
So, Latanya, the 1099 will be issued by whoever administers the DC plan,
that
right?
is correct.
If it's VOYA at the time,
Yes.
10 years later, then 1099 will originate from
That is correct.
VOYA.
That is
Thank
correct.
you.
Yes. Just like your LACER's pension, you're going to get a 1099. If you didn't take any withdrawals from deferred comp, no 1099. Let's see. Okay, so I talked about the special catch-up earlier. You have that. You can also do what is called an in-plan Roth conversion. If you decided that you wanted to, not have to deal with the tax man at retirement, you can convert some of your pre-tax dollars to after-tax dollars over the years. Some people do this as a strategy. They get the benefit of putting the money in pre-tax while they're working during their, aggressive working years, because they need that write-off. They're at the higher salaries or whatever. And then when they get closer to retirement, or, they may start converting that money from pre-tax to after-tax. And then that way they don't have to pay the IRS upon retirement. A lot of young people choose the after-tax Roth because they don't like the IRS at all, and they don't want to have to deal with them in retirement. So they just say, what the heck, I'll pay them now, because they've seen how the government works. A lot of millennials are opting for the after-tax Roth dollars. But some of us old timers, I'm an old timer myself, I'm used to the pre-tax, and I prefer pre-tax because I need to lower my taxable income. I don't want to give the IRS all my money during the year, so I want to show I make less money. So it's just a preference.
Latanya,
and then I'll deal with him later.
Okay. Latanya, could you do the conversion after you retire? Let's say I retire.
You can do it anytime. You can do it anytime.
And
it's
I
not
already
based on
retired.
age.
Okay. And then
it's not
I already
based on
retired
age.
from the office, from the city, and I'm gonna withdraw my money at 72. So I'll do the conversion, let's say 3 years before my required minimum. Required
your
minimum,
RMD. You still have the 5 year, but you still have the 5 year rule, but you've satisfied the age already. You still have to wait the 5 years for in-plan Roth, if you don't have any Roth dollars, because it's the first time in conversion from first deposit of Roth dollars. So if you did it at 60, you took it out at 65, you don't have any issues with the tax man because you already paid them. When you convert, it becomes taxable in the year in which you do it. So say you convert $5,000 this year before December 31st, that's additional $5,000 income. You're going to get a 1099 from us and you file it with your taxes. So that's how the in-plan Roth conversion works. You can do it anytime while you're active or retired. It's completely up to you. There's also, at the end, we're getting extremely busy with this right now between the catch-up and the accrued leave. When you leave city service, the city allows you to take your unused vacation and sick time, 100% vacation, 50% of the 100% sick, any overtime, and put it into deferred comp up to the maximum allowable limit under the IRS. So say, for example, you are about to retire. There are a lot of people taking the SIP right now, and some people have contributed during the year. I had one person contribute $30,000 because they're in the catch-up. So the only thing of their payout they can put in is $9,000, and they have to take the rest in taxes. So if you elect to take your accrued leave payout, it does come from a separate payout, and you can put it into deferred comp. If you decide to take it as cash, the IRS taxman cometh between 34 and 39% on that payout. It is not your normal tax rate. So if I have people on this call that are trying to decipher if they're going to retire and they're saving their vacation and sick time to take the money and run, think again. The IRS is going to be on your heels for their tax money. So no way to get around taxes.
But LaTanya, but the max is 39,000, right?
Under the special catch-up provision. If you've
Right.
already, and keep in mind, catch-up is a one-time 3-year provision. You can only do it once in your work time with the city. So if you've already done the catch-up, then you go back down to the 26,000 limit. If you've, and then up to 26,000 is all you can put in if you've already satisfied the catch-up.
Thank you.
Sure. Let's see. Ways to access your account is online or the VOYA app, as Liz mentioned earlier, and you can contact our service center. You also have 5 local representatives to assist you. We are available Monday through Friday from 8 a.m. to 4 p.m. You can also schedule an appointment with us. If you go to LA457.com, the contact us, you can reach us. You can reach us by email at la457@lacity.com. That also is on the website. We are now also offering virtual office hours. In light of our new environment, we can't get out to do meetings in the field and personally, so we have what is called virtual office hours, where we are conducting specialized meetings. Our next one is November 18th, and it's going to talk about pre-tax versus after-tax. One of the representatives will be either myself or one of the other representatives will conduct that meeting, and we will answer, we'll talk for about 15-20 minutes, and then we'll do a Q&A at the end, because we find that in order to, it's just an extension of our service to make sure that we're still able to provide the service, the quality service that we like to offer in light of our new environment. So with that, I am going to add my, now we can do some Q&A, and I'm going to add my, I'm going to add my phone number in the chat feature if I can find it. Chat. I'm just going to put my phone number
LaTanya,
there.
the phone number is already noted on the chat. I think Lolita had
Oh, good. Thank you so much.
copied
That's
and
great.
pasted it. So your email and your phone number is available.
Thank you, Lolita. I appreciate it.
Members.
Okay,
Thank
now
you.
I'm ready for questions. I know I have a lot of them.
All right. Davina, would you like to ask your question right now, or do you want me to read it for you?
You can read it. Fine with me.
Okay, well, she has a question here about well, we have 5 minutes. She has a question of whether you could designate your deferred comp to go to a living trust as beneficiary.
Yes, you can. So let me explain. I didn't mention, I mentioned beneficiaries briefly. Okay, so deferred compensation is a retirement account, so it already has its own beneficiary. You have the option. The purpose of a living trust is to give the instructions on what to do with your assets. And the reason why people do living trust is because some assets don't have a beneficiary, such as your home or your car, but deferred comp, you can designate who you want. So it would go to the trust, and then the trust would have to pay the taxes. But you have the option to designate a person. If you designate your your spouse, they would get 100%, and then they take over the account in case something happens to you, and then they designate their own beneficiary. They have the option to keep the money in the account for indefinitely, and they manage it. It goes in their name, and they manage it the way they want. They do have the options to take distributions or leave it in the plan or however they want. If it's a non-spousal beneficiary has to take their money out 10 years after your passing. Okay, they could roll it over, they could take a distribution, or they could roll it over or do a distribution. Those are the only two options for getting money, but they can maintain the account for 10 years after your passing, and then they have to take the money out. They are required to pay taxes. Taxman coming, nobody gets around him. But yeah, you can designate a living trust, but it's honestly, it's not necessary because you can designate a beneficiary for deferred account.
All right. Do you have any more questions? I don't see any more in the chat.
What? I answered them all?
I think we did a lot of questions in between. So I'd like to turn it over to Jing for closing remarks. All right, Jing.
Thank you so much. I believe I'm just going to mention LaTanya. We appreciate you taking time to provide us educational information, not only for LAFACE members, but everyone, because we opened this to everyone. Everyone who attended, we appreciate your attendance. And also, if it wasn't mentioned earlier, we want to thank Mr. Steven
Montana.
Oh, he did mention, that's wonderful. So shout out to Lolita for making sure we have the moderation of this Zoom seminar. This is the first time LAFACE did this, a financial education seminar, in honor of October as National Retirement Security Month. So we will have another one perhaps by next year. I believe, LaTanya, we may be able to pull you in again. And Liz
Absolutely.
also mentioned that by January, perhaps LAFACE can host or sponsor another financial seminar. Everybody loves to talk about money. And I just wanted to say LAFACE is here for you, for all those who attended. Thank you. And then we are here for you as a LAFACE organization. Liz, we also thank you for bringing in LaTanya, VOYA, you being the commissioner and also advisor of this wonderful association. So LaTanya, hats off to you. Thank you, Liz.
Oh, thank you for the opportunity.
Yes, if you have anything else to say, if anyone else would like to say something, we are here via text. LAFACE is here via text. And also you can contact us via emails.
Yeah, Jing, do you want to mention our YouTube channel? Are you going to post this?
Oh, yes. We are going to post this if, we're going to make sure that we have the recording posted to still spread it far and wide, the educational value behind this. It's one of those major benefits of LAFACE. We're providing educational value to everybody. We have a YouTube channel, LAFACE. We have created it and it's in YouTube, so we'll probably do this. And of course, you must visit the Facebook of LAFACE, which is just search out LAFACE. We are on Facebook. We also post some of our most valued presentations like this one. So we also have a website. So you are more than welcome to visit. We have wonderful, wonderful videos about Filipino activism, about honoring the nurses and the DSW workers from the city. We also have one talking about the Filipino History Month. So a lot of educational materials for everyone. So thank you for mentioning that, Liz, that we do have a YouTube, we have a website, we have Facebook accounts that everyone can visit. If you're looking for something about the city or opportunities, look for LAFACE.
So thank you, everyone.
Go ahead,
go ahead, Jing.
When you do your distribution, anyone who's retiring, don't forget LaTanya. I heard it earlier that, yeah, don't forget. So congratulations to whoever is going to retire. And
Yes,
us who are still-
congratulations.
us who are still working, we will be making sure that we put our money wisely. And thank you for your guidance, Liz and LaTanya.
Oh, you're so
I
welcome.
just
It's a
want to say,
pleasure.
yeah.
Thank you.
Thank you
Sorry,
everyone for
Latanya.
joining us this morning.
Yes.
I just want to say, keep on saving.
Absolutely. And give me a call if you have questions.
Bye.
Thank you. You guys
very
have a
much.
nice weekend.
Great job.